Give ZEO $100 in cash. Now ask him to buy something for $70. He hands over the bill and gets $30 back. He can see exactly what happened. 100 became 30. Now reset the experiment. Same ZEO, same $70 purchase. But this time, tap. Done. No cash disappeared. Nothing in his wallet looks smaller. The purchase feels almost weightless. But his bank account? It definitely noticed. So here's the question. Does changing how we pay actually change how much we're willing to spend? And if it does, what happens when paying becomes almost invisible? Last time, ZEO discovered that a 30% discount could make spending $70 feel like saving $30. So he learned a simple rule. Ignore the sale sign. Look at the actual money leaving. Good rule. Small problem. Modern payments have become extremely good at making that money harder to feel. Cash gives you physical evidence. You open your wallet. You remove something. You hand it away. You leave with less of it. A card changes the experience. A phone changes it even more. A watch? At that point, apparently buying lunch requires roughly the same physical effort as checking the time. And that tiny difference matters more than it appears. Because paying isn't only an accounting event. It's also a psychological event. Behavioral researchers use a wonderfully dramatic phrase for this. The pain of paying. Not physical pain, obviously. Nobody needs medical attention after buying groceries. Usually. It's the psychological discomfort attached to giving something up. With cash, that sacrifice is highly visible. Imagine ZEO buying dinner for $100. He counts 20, 40, 60, 80, 100. Every note reinforces the cost. Now compare that with tap, beep, approved. The economic cost can be identical, but the experience isn't. And classic behavioral research has found circumstances where people using credit cards showed a higher willingness to pay than people using cash. That doesn't mean every human automatically spends more every time a card appears, but it reveals something important. Payment method can influence the decision itself, and the reason becomes clearer when we separate two moments that used to happen together: buying and paying. With cash, consumption and payment are tightly connected. You receive the thing, you lose the money. Same moment. Credit cards can loosen that connection. ZEO buys the jacket today. He wears it tomorrow. He forgets about the purchase next week. Then, sometime later, the statement arrives. The pleasure happened first. The bill appears later. This separation is known as payment decoupling, and psychologically, that matters. Imagine every restaurant made you pay for each bite individually. Bite, $2. Bite, $3. Bite, another $2. Dinner would become a remarkably hostile experience. Payment is usually separated from consumption. Credit cards can extend that separation much further. Enjoy now, account later. But delayed payment isn't the only thing changing our behavior, because modern payment systems have been removing something else: friction. Cash, count it, hand it over, receive change. Then card, insert, PIN, then contactless, tap, then phone, face, done. Each generation makes payment smoother, and convenience is genuinely useful. Nobody is suggesting we return to paying for coffee with livestock. But friction has a hidden benefit. It creates a moment in which your brain can reconsider. Imagine ZEO sees a $30 gadget. With cash, he opens his wallet, checks what he has, counts the notes, maybe pauses. With contactless payment, the transaction can be finished before his internal finance department has finished loading. Reducing friction makes good purchases easier, but it can also make unnecessary purchases easier. And that's why the important question isn't simply, is digital payment good or bad? It's what happens to our decisions when spending requires almost no physical effort. Now consider a normal day. Coffee, tap. Train, tap. Lunch, tap. Snack, tap. Online purchase, click. Each transaction is small. Nothing feels dramatic. But something unusual happens when spending becomes fragmented into tiny, almost forgettable events. At the end of the day, ask ZEO, how much did you spend? He may remember the large purchase. The small ones? Not necessarily. Research on contactless payments has found weaker expenditure recall under some conditions compared with more salient payment methods. And that's important, because controlling spending requires knowing that spending happened. It's difficult to manage a number your brain barely recorded. One $12 purchase won't destroy ZEO's finances. Neither will the next one, or probably the next. The problem is that modern spending doesn't always arrive looking like a financial decision. Sometimes it arrives as a sequence of tiny conveniences. And then credit cards add another layer. They can make spending feel like earning. Spend $100, receive points, miles, cashback, rewards. Suddenly the transaction contains two messages. Your account says minus $100. The reward screen says congratulations, which is psychologically interesting because spending has just been given a positive score. Now, rewards can absolutely be valuable when used responsibly. If ZEO was already going to spend $100 and get something useful back, excellent. But rewards can also change the story inside his head. Instead of, I spent money, it becomes, I earned points. This is where mental accounting enters the picture. Humans often don't treat every dollar as psychologically identical. Salary money, bonus money, gift money, reward points, cashback. They can feel like different categories even when they ultimately affect the same financial life. And if ZEO buys something unnecessary just to earn the reward, the mathematics becomes wonderfully efficient. Spend $100, get $1 back. Net result, congratulations, you have discovered $99 cashback. Now suppose ZEO has $1,200 in his bank account, but his credit card shows available credit $8,000. That $8,000 can feel strangely like spending capacity. But it isn't income, it isn't savings, and it certainly isn't a surprise gift from a very generous bank. It's permission to borrow. This distinction matters because the card changes the constraint. With cash, ZEO eventually runs out of cash. With debit, he eventually runs out of money in the account. Credit introduces another number entirely, what he is allowed to spend. And the gap between what can I afford and what will the card approve can become enormous. That's where a convenience tool can quietly become a debt tool. But there's an even stranger number on a credit card statement. One that can make a large debt look surprisingly manageable. The minimum payment. Imagine ZEO opens his statement. Balance $2,400. That's uncomfortable. But underneath it, minimum payment $72. Now, which number feels easier to deal with? Obviously 72. And that's precisely why small numbers can influence financial perception. The full balance represents the actual debt. The minimum represents the smallest immediate action required to remain within the account's payment terms. Those are very different things. But psychologically, the smaller number can become the focus. 2,400 feels like a problem. 72 feels like a task. And humans love converting problems into manageable tasks. Unfortunately, interest also enjoys this arrangement. Very much. The lesson isn't that minimum payments are inherently deceptive. They're clearly disclosed. The psychological lesson is simpler. The number receiving your attention can shape how serious the debt feels. Sound familiar? That's the same brain we met in episode 1. Different financial product, same human. At this point, you might think, fine, now that I know all this, it won't affect me. Excellent. That's usually when psychology becomes particularly entertaining. Knowing a bias exists doesn't automatically switch it off. ZEO can understand anchoring and still notice the sale. He can understand payment friction and still prefer tapping. He can understand credit and still think, I'll deal with that next month. Financial behavior isn't just about information. It's about designing environments where the better decision is easier to make. Because willpower has an unfortunate habit of being strongest, roughly 3 hours before you actually need it. So instead of trying to become psychologically invincible, ZEO can change the system around himself. And there are 4 simple ways to do it. 1. Use the full price. Before tapping, say the actual amount to yourself. Not, it's only $20 a month. Ask, what is the total cost? Turn fragmented prices back into one number. 2. Check the account, not the credit limit. Your credit limit tells you what the lender may permit. Your budget tells you what your life can support. Those are not interchangeable. 3. Add friction to impulse purchases. For anything unplanned above a personal threshold, wait. An hour, a day, whatever works. The goal isn't suffering. It's restoring enough time for the excitement of buying and the reality of paying to meet each other. 4. Make the bill visible. Notifications, weekly spending reviews, automatic full balance payment where appropriate and affordable. Whatever system makes the total difficult to ignore. The principle is simple. If technology makes spending invisible, make it visible again. But because your brain is extremely talented at ignoring costs that aren't demanding attention. And this is important. Credit cards themselves are not automatically bad. Used carefully, they can provide convenience, consumer protections, transaction records, rewards, and short-term payment flexibility. The psychology doesn't say, cash good, card bad. It says different payment methods create different experiences, and experiences influence behavior. For one person, a card is simply a payment tool. For another, the same card removes just enough friction to increase impulse spending. The question isn't whether ZEO owns a credit card. It's whether the card changes the decisions ZEO makes. Because the most expensive feature of a financial product isn't always the fee printed in the terms. Sometimes, it's the behavior the product makes easier. So return to our original experiment. $100 in cash, spend $70. You physically watch 100 become 30. Now pay 70 by card. Tap, beep, finished. Same price, same product, same ZEO. But not necessarily the same psychological experience. Cash makes the loss visible. Cards can separate buying from paying. Contactless payments reduce friction further. Rewards can make spending feel productive. Credit can move the consequence into the future. And suddenly the method of payment isn't just carrying out the decision. It can become part of the decision. But credit cards still have one inconvenient feature. Eventually, the bill arrives. So companies found an even smoother proposition. Don't pay $100 today. Pay $25, then $25 later, and later and later. Same purchase, smaller numbers, future consequences, which raises a rather dangerous question. If delaying payment makes spending easier, what happens when we split the payment too? Next, buy now, regret later. The psychology of buy now, pay later. Because apparently future ZEO has plenty of money. Present ZEO has checked. Buy ZeoNomics. Money makes sense. People don't.